Our next guest says that he expects the CPI report to validate this higher for longer narrative when it comes to the Federal Reserve and interest rates. He also says that the latest measure of CEO confidence shows that business leaders are feeling a tad gloomier about the economy. Right now, we want to bring in Roger Ferguson. He is the vice chairman of the Business Council and trustee at the Conference Board. He's also a former vice chairman of the Federal Reserve and a CNBC contributor. And Roger, we heard all the commentary from the FOMC meeting minutes yesterday that were released. It sounded like a lot of the officials at the table thought, yeah, we could raise rates one more time, but it definitely feels like the narrative has changed in the last several weeks, just given how much we've seen a rise in interest rates. You think they're going to do anything at this next meeting?
I think I'm with your analysis, which is I've read those minutes, and they certainly suggested that the vast majority of the members and participants think that the rate is in restrictive territory, and there seemed to be a notice of the balances being much more two-sided. So that plus Fed commentary suggests to me, as to many others, that they're unlikely to move in the November meeting.
And is that subject to change as well if we get a super hot consumer price index today?
I think it is subject to change. Two reasons. One is, they've always said they're very data dependent. Two, there's a little bit of a surprise in the PPI, so people are set up for maybe, another possibility of a surprise. And third, let's not forget that the forecast that they had, the vast majority of them did expect one more hike. And so there are plenty of reasons why, should there be a surprise on the CPI, this meeting could be a live meeting. So I don't think we should be at all complacent about the possibility that the Fed is done. It may be one more and then done.
How does war in Israel change that potential perspective, though? How do they view all of that? I would guess they want to be even maybe a little more cautious as they see how things play out.
I think there's a need to be a bit more cautious, as in there might be some sectors that are affected in terms of supply chain. On the other side, though, we see, as we saw the last time around, that energy prices spiking can have an impact on the PPI and ultimately feed into, pricing that consumers face. And you heard from, I think, a CEO of one of the airlines talking about fuel prices and what that might mean for pricing. And so I think, the story in Israel creates greater uncertainty, but it's an uncertainty on both sides as far as the central bank might be concerned here in the U.S.
Roger, we haven't talked to you in a little while. What have you thought about this huge run-up in yields? I mean, we've come back down a little bit, but it was a kind of an untethered move, something that was much more than what the Fed itself was directing. Is that a reason for concern, to the idea that things are untethered, that there are movements in the market, or is it a good thing because the Fed says the market's been doing its job for it?
Well, certainly you've heard from many of the Fed speakers that the market has been doing its job. You've heard a number of them say, basically, though they don't know exactly how much the tightening in the market is the equivalent of, a tightening move by the Fed itself. I think the movement reflects a number of things. First, the real understanding of the higher for longer narrative. I think that played in after the last meeting. Certainly a recognition that supply and demand dynamics, i.e., the deficit situation here in the U.S. is not likely to improve anytime soon. But also I would say, we've gotten used to relatively low rates by historical standards for the last decade or so. And this might be a reflection of a regime change towards rates that are, much more normal, both at the short end and at the long end of the curve. I am not in the position where I would say, oh, gee, this is really worrisome or things are totally untethered. I think it's moved quickly, but it's a reflection of, I think, some underlying realities becoming more evident in the market.
So the Business Council and the Conference Board released their fourth quarter CEO confidence survey, and it showed that the CEOs are feeling a little gloomier at the beginning of the fourth quarter than they were at the beginning of the third quarter. How about you? How are you feeling?
Well, let me explain, I think, what they were seeing, because I'm the vice chairman in charge of these surveys. And what the CEOs were telling us was, yes, slightly more gloomy, still in the territory of expecting a possible recession. And I think what's driving is two or three things that they told us. One is labor markets are still very tight. Two, many of them do continue to expect to raise wages in the range of 3%, which may be a little higher. And I think they were also seeing what we've heard some other CEOs anecdotally. These borrowing costs have certainly gone up at the same time when that was taking place. equity valuations were down. So inflation in the pipeline still exists for many of these CEOs. And I would say that's all consistent with the Fed story, the story we've been sharing. Inflation has not gone away completely. It is moving in the direction the Fed wants. But the Fed and I think CEOs are both watching this situation as it unfolds. The final thing the CEOs told us is there's still a lot of risk, cyber risk and now geopolitical risk seem to be weighing on them as well. And so, I think there are reasons for them to be, somewhat more pessimistic, but still driving their companies towards growth.